everybody. Wow. Literally 30 seconds ago, I was teaching entity structures in cannabis to about 300 people and got off and got on here quickly, and we'll just switch into GAAP and cannabis accounting. I've got a couple of links. 47111 is a very good one to read, so I'm just going to toss it in here. You should read this inside and out if you deal with cannabis. It relates to inventories and manufacturers. And so in the cannabis world, we have many verticals. We have farming, then we go to chemical processing plants to turn that flower into oil. This applies to CBD hemp as well. Then we go to product manufacturers, could be foods, beverages, tinctures, lotions, gummy bears, you name it. Then from there we go to distributors, distribution companies, and dispensaries and delivery companies. But the first few verticals 471.11 applies to. This is very good news because remember 280E says you cannot take any deductions or credits on your tax return. Now, the only bright light in that is that inventory and cost of goods sold are not a deduction or credit. They're return of capital under the tax code. So the more dollars I can get, if I'm a farmer, I want to get as much dollars into inventory as I can, because when that inventory is sold, it becomes cost of goods sold, and that is the one and only thing that's going to show up on my tax return. So if I want to correctly minimize my taxes, which all farmers do, most of them, they don't want to incorrectly minimize taxes. I tell them that's a bad idea because the IRS is coming. And many of them are doing that right now. They're just doing their tax returns flat out wrong. But I want to correctly minimize that tax. How does GAAP play into that? Well, right here in 471.11, it tells you your inventory, you better be using the full absorption method of cost accounting, and it also should not be inconsistent with GAAP. Let me see if I can find that statement. It's, first of all, you got to be doing it in recurring financials. I'm just going to plug this in right here. So the general rule, it will state you must be doing this to your recurring financials, and it also must be in accordance with the treatment in the financial reportments and generally accepted accounting principles right there in the tax code. When people say, where does it say that? Well, there it is right there. The last few words are generally accepted accounting principles. So we want to be doing good cost accounting. How many farms and product manufacturers in cannabis are doing good GAAP cost accounting? I would say 1 out of 10 at best in the U.S. I've almost never seen it. It's actually not super simple because before Dope CFO, the tools and work papers and systems weren't out there. Like, for example, we have our flower calendar, we have our cost accounting templates built to do this. We need to be tracking every different strain on the farm. Could be thousands of plants. We need to know what stage of completion, percentage complete they are, and estimated yield. So maybe if I go out to barn A and I find 6 Gorilla Scout or Gorilla Glue. What am I thinking? Girl Scout cookies. Say I find the Gorilla Glue and I find out, okay, at this farm, maybe their Gorilla Glue, each plant yields 1 pound of weed. Maybe I have another client that grows Gorilla Glue a different way and they get 2 pounds of weed or half a pound. I need to know for every strain their estimated yield. We need to know the percent complete. So what if I got one plant that I planted yesterday and say here we are at month end for 430 and I planted that plant at 429. I need to know their full growth cycle. I need to know planting, veg, flower, harvest, drying, curing it, trimming it, off to the lab, back from the lab, all those different stages. Some companies can do it in 100 days, some it's 200 days. We need to know each client, where they are on the cycle and where each plant is. Maybe another plant is already back from the lab, it's ready to sell, so it's just about to be moved out of work in process. So all those plants are work in process, but once it's ready to sell, it's actually a bag of packaged tested flour, that's when it becomes a finished good on the farm. Usually finished goods are going to move quickly, hopefully, unless there's a glut, which has happened before in Oregon. So another piece of our inventory cost accounting, we're going to value at lower of cost or market. So if, like what happens in Oregon, if we all of a sudden get a big glut of flour and flour is sitting there and by the way, it does have a shelf life in the barn, and price tanks, like it did here from 2,000 a pound down to say 300 a pound, we might be doing a write down on our inventory to market. That is not a good thing to have happen, because that does not fall into cost of goods sold. So we need to be very, very careful. We need to have the tools and work papers and system to do that good GAAP cost accounting. I put in another link here as well. This is just kind of general reading if you want to on this doesn't have to do cannabis, but just on a couple of links here on GAAP cost accounting if you want to dive in and educate yourself, or you forgot from college what it's all about. So anyway, let me make sure I don't have any questions. So we have to be doing that. We want to be careful to be doing this absorption costing correctly. And so how does that apply at the farm as well? We've got direct materials and direct labor. 100% of that is going to go into our cost of WIP when we do that end of the month. But then we need to go down the trial balance line by line. Well, what about rent? What about indirect labor? What about soil? What about soil will be a direct cost? What about insurance? All these different costs, and we're going to want to put them in accordance. We're also going to want to be very careful as we go down 471, and we make darn sure we're not violating what 471 says we can put in inventory. So for example, they have 3 categories when they're talking about indirect costs. The first cost are things you need to put in your inventory, and I'll just read them: repairs, maintenance, utilities, heat, power, light can be huge dollars. Rent also can be huge dollars. Indirect labor and production also can be huge dollars. Indirect materials, tools, cost of quality control. Then it tells you what should you not put in your inventory. We've seen people do this. Marketing, advertising, selling, distribution, interest, don't do it. And they list some more things as well. You can read that later. The final category is the important one. If you're doing this cost accounting quarterly, so you can't come in, if you're the tax preparer, you can't just drop in at year end and do this. You need to be doing this, in my opinion, at least quarterly. That's recurring, the cost accounting. If you are doing that, good news for the farmer. You got to put more costs in inventory. And what are those costs? Taxes, depreciation and depletion, employee benefits, costs attributable to strikes, rework labor, scrap, and spoilage. That can be huge. Factory admin, officer salaries, insurance costs. That can be a big pool of costs. Make sure you're doing that right. So this is an easy pitch for Dope CFO people in the program. They show up at the farm, maybe the generalist CPA is doing the books. They haven't thought about any of this stuff. They're not doing it. We say, look, you're paying too much in taxes. Either, I tell them actually there's 2 choices. One, your tax return's wrong, and you've incorrectly minimized your taxes. That's going to come back to bite you in the butt. Or conversely, you're not doing your taxes. You're paying too much because you're not getting that category 3. And so by us coming in and doing that correct cost accounting, we can save you a ton of money. So anyway, that is my talk for today. If you can always message me or comment down here, and I can put more info in there or answer you there, or check us out at dopecfo.com.